Hello, this is Edmund Xing of BCS Asset Management. In this week's Global Equity Strategy presentation, we look at whether stock markets are at a turning point. We're going to look here at four things: stock market breadth, how is the stock market trend developing, volatility, emerging markets, which have been the source of much of this volatility, and the bond market. Starting with equities, we can see that the average US stock, here represented by the value line arithmetic index, has not broken its uptrend which started in late 2012. Seems very much in place. You've had a small pullback, but that's all. Still a bull trend for now, for the average US stock. The same is true for the average European stock. Using the Stocks Europe Equal Weight Index, we see that the uptrend from middle of last year is unbroken as of now and is starting to pick up again. So, no break in trend, average stocks in the US and Europe still doing well. In terms of volatility, secondly, we can see that implied volatility at the midterm maturities has hardly risen in recent days. Look in comparison to what happened in early and mid 2013, you had much bigger spikes in midterm volatility. We haven't seen that this time yet. Second, in terms of macro risk, another way to look at volatility, similarly, we do not see in this week's spike anything like the spikes we saw in mid of 2013 or indeed in previous years. So the volatility, frankly, is not as bad as people are making out when you look at the historical context. If we look now, thirdly, at emerging markets, we can see that the emerging markets ETF EEM in the US has not even gone back to its 2013 year low. If we look at currencies within emerging markets, we see quite different stories. Yes, the green line, the ruble, has seen a sharp spike in implied volatility as the ruble has depreciated sharply against the US dollar. But this is not really true for either the Mexican peso in blue or the Indian rupee in grey. In terms of the bond markets, well, no real scare stories to be seen here. The spread between Spanish and German sovereign bonds is actually continuing to compress, so that tends to be a risk-on trade, if anything. US junk bond yield spreads as well have not really jumped much. They're still under 4%, which in historical terms remains very low. So to sum up, the stock market trends to the upside remain intact for now in the US and Europe. Volatility levels remain very modest in the historical context. We see only mixed reactions from emerging markets. They are not all reacting in the same volatile way. And there's no obvious flight to safety reaction from investors in the bond markets. So I would conclude you stay the course in risk assets now. This is only a small bump in the investment road. The real question mark is the timescale over which the US Federal Reserve will increase tapering. That could introduce further volatility through the rest of this year. This is Edmund Xing from BCS Asset Management, wishing you a happy Chinese New Year of the horse, and let's hope it brings us good news for the stock markets.